the tax business. And what myself, I'm based in Hong Kong. That's where we started our business. And I have been doing this for the last decade since I came back from Sydney to look after people from all around the world, Hong Kong, Singapore, UK, US, Middle East, Europe, etc. Pretty much I've been dealing with over 100 countries for people who have been around and having issues back in Australia. So hopefully that give you again a bit of info about the company and myself. So let's dive in into the webinar, and let's just give you a quick overview on what we have discussed on the last webinar. The first one, we talk about tax residency. A lot of people interested because that really applies to everyone. On the last one, that we talk about property tax in Australia. How does it work if you, being either an Australian or foreigner based overseas, would be interested to buy a property in Australia? How does it work in terms of buying, holding, and selling the property? And we are keeping the topic of capital gains in this section, and we're gonna go deep into it and give you a few examples on how the work is calculated and how you can minimize your tax as possible. I'm also talk about negative gearing, which still applies on anyone living overseas. So if you're an investor, want to buy a property in Australia, and don't afraid that negative gearing still applies to help you minimize the tax. Some of the other tips on structure, how to better structure your ownership to minimize the cost, and what are the tricks that we've been seeing from a mortgage perspective that can also help you get lending, but still minimize the cost of buying a property in Australia to the minimum. So what we're going to talk about today, it's focusing again on capital gains tax in Australia. We're going to quickly talk about what is it, how is it calculated, and we probably put a lot of focus on property because that is from our database. Most of our clients would have an issue comes from capital gains. It's actually coming from property. So we're going to dive deep into how does the calculation work, giving a few scenarios on under each different scenarios, what are the rules that would apply and affect you in terms of how much you need to pay at the end of the day to the tax office, and what are the strategies we can help you reduce the tax payable, again, to minimize your tax when you sell eventually from the property. So what is a capital gains tax in Australia? I know in some countries they don't have capital gains, they pay nothing. When you sell, say, a shares or sell a property, you don't really need to pay a capital gains, but it exists in Australia, which is a tax on profit on selling an asset in Australia, for example, like a property or shares. A quick example here. Let's say you buy a property, you buy a house for $800,000. After a couple of years, you sell it for 1.2 mil, you make a 400K capital gains. And again, this is capital gains. This is not capital gains tax because tax will then apply on this number to see what tax you need to pay. And this, again, the 400K is before any of the capital gains tax discount or any exemption that might be available to you or may not be. So we need to factor in some of these deductions to see, can we reduce the capital gains further, and what sort of tax bracket that we need to pay tax on it. When does it apply? It applies when you sell a property uh, or when you change your tax residencies. So that happens if you are coming from Australia, moving overseas to be a non-resident. There's actually some elements of capital gains tax apply on the switch of your residencies. For example, we could be looking at shares that you have an option to do what we call dim disposal, to dim that you sold the shares at the time when you become a non-resident. So then these will not be no longer taxable. Quick example here, if you're a resident for tax purpose, you're gonna be taxed on your worldwide assets. Like if you own a property in Hong Kong while living in Australia, that Hong Kong property is also taxable in Australia. If you're non-resident, which I think most of our clients are at this meeting, at this webinar, that you are a non-resident, you will only be liable to pay the capital gains tax on Australian properties or some of the indirect interest on minings, for example. Okay. And one thing to bear in mind, I have a little warning sign there about the main residence exemptions for non-residents. So this happened in 2012 that the rule changed that if you're selling your main residence as a non-resident, be mindful you will lose the exemptions on the main residence. The government is going to treat it like a normal investment property. So make sure you understand the rules before you make any decisions on selling. And we'll give you some examples down the line to show you how does the calculation work on this scenario. And there have been some confusions. People think, oh, this is my capital gains tax. How much do I pay? Then what is my income tax? They are actually capital gains is actually a type of income, like you might be earning from employment, from interest income, from dividend, from personal business income, etc. They all bundle together at the end of the year at your tax return to see what is your total taxable income for the year, and you pay tax on it. So this is not separate. I've heard people saying, oh, my capital gains tax rate is 30%. Is that right? Not really, because it could go up to 45, depends on your marginal tax rate. So, and it could be zero because you could be paying nothing based on the capital gains calculation. So, again, it will be taxed when you sell it, but for income like from work, it's something tax you when you receive the income. Um, uh, they will be added into the income and taxed at the marginal tax rate like the normal employment income all bundled together. And for capital gains, you will only declare it when the event happens, when you dispose an exec in Australia. But for other income, employment income interest, that will be likely to be annual income that you need to declare. So we don't need to pay any tax if you're still holding the property. And the deductions, there will be a bit more when it comes to deduction, what you can claim against the capital gains tax that we'll be looking into the cost of acquiring the property, cost of holding the property, and cost of selling the properties. So the rule of thumb is pretty much every dollar you spend on buying, holding, owning the property is somehow deductible in some areas. But when it comes to the normal income, there are limited options of what you can claim. Work related if you're having employment income or some business expenses. So the rules for non-residents, we break it into two parts. One we call a taxable Australian property. It's a terminology that we use with the tax office. What does it mean is these only refer to Australian real estate or business access or mining rights, indirect ownership of mining rights, for example. So from here you can see I'm not putting the shares in this category under the taxable Australian property we call TAP because for shares or equity like crypto, whatever, on the equity market, if you buy them and sell them as a non-resident, this is what we call a non-taxable Australian property. So you don't pay tax on these, so as any of your foreign investments, like say you've been living away from Australia as a non-resident and you buy a place in the US, that property is not taxable in Australia because you own them as a non-resident. Whatever profit loss you make on that property has no impact or obligation in Australia. So you then need to disclose that to the Australian government or some of the pre-1985 pre-CGT acts that also will not trigger any tax as well. The difference when it comes to resident and non-resident is really the capital gains and the main residence, a few areas. So how do we first do the calculation is we look at the sales price minus your purchase price, and then minus the eligible expenses. For example, stamp duty, legal fee, renovation, agent fee, marketing, etc. These are the costs that surrounding with the purchase and selling the property. All of these will be included to look at, all right, what is your net capital gains? And you will only pay tax on the net capital gains. Two more things would add into this. One is whether this is your main residence. If this is your main residence, you could get exemption. So you pay no tax on the property or no capital gains tax on it. And everyone can have one property to be declared as their main residence and pay no capital gains tax on it. But when it comes to investment property, your whole as an investment property, not something that you live into. If you're a resident of Australia, you can still enjoy the 50% capital gains tax discount if you hold a property for more than 12 months or shares for more than 12 months. But when it comes to non-residents, situation kind of changed because there has been a lot of rule changes in the last 10, 20 years, and some of them are that we no longer, as a non-resident for tax purpose, we no longer enjoy the 50% capital gains tax discount after May 2012 when the rule changed in that year's budget. And we pay higher tax compared to people in Australia because we don't enjoy the 18,000 threshold. We pay tax on the first dollar at 30% on the first $135,000, and the rate goes up to 45% if you earn more income at the end of the year. And this is another thing about the 50% foreign resident capital gains withholding. That also we had a rule change this year that also kick in and affect when it comes to time of selling, and we're gonna have an example on this one that I will show you how does it work as well. So let me just dive into real examples on how does it work, so make it easier for everyone to understand the scenarios. Let's say we have an example here on an investment property that this is an Australian property, so Australian expat who bought a property in New South Wales for $700,000 in 2016 and sold for $1 million in 2024 with an associated cost of $90,000, including stamp duty, legal, agent fee, agent commission, etc. And the Australian expat also have an accumulated tax losses of $100,000 because the property has been running in negative gearing positions, and he has been able to claim some of the tax losses from previously when he owned the property. So if he sell if he's been a full-time non-resident or has always been a non-resident living overseas for this from 2016 to 2024, the 8 years. The way we're gonna look into it is, all right, your sales price minus your cost base, the purchase price minus cost of holding the property, you would have a capital gains of $210,000. Um, because you own the property in 2016, which is after May 2012, where the 50% capital gains discount is no longer available to us, and you have been a full-time non-resident living overseas, so you are not eligible to any of the capital gains discount. You would pay tax on this $210,000. However, because you have accumulated losses from here, that $100,000 will kick in and help you minimize the income for the year. So instead of having 210,000 income for the year, you will only have 110, and then you pay tax on the $110,000, which is 30% as a non-resident. So you would end up paying a tax of $33,000 to the tax office out of the capital gains of 210. So this is the scenario. If you're thinking buying a property right now, gonna remain as a non-resident of Australia, this is the simple direct calculation that you can expect to have on selling the property as a non-resident. To further reduce tax on this, there are strategies that we can look into, which is with super. So if you qualify, you can make a superannuation concessional contributions to reduce the tax payable. So this concessional contribution right now is capped at 30,000 per year. So everyone can claim up to 30,000 as a concessional contribution that becomes deduction in your personal tax return. You can claim it as a deduction to minimize the income you have for the year. We also have this carried forward unused concessional contribution cap up to 5 years, which means you could be looking at 30 times 5, or obviously the cap was not that high in some of the year before, 27,500 last year. and 25,000 before. So you somehow maybe getting something like 100,000, 110, for example. And let's use the same example that we have without applying the super contribution method strategy. You have 110,000 income for the year, which you pay tax of 33. But imagine if you putting this 110 into your super and claim it as a transactional contribution, it will reduce your personal income to zero, which means you're no longer paying $33,000 tax to the government. You pay zero because now your position is no income for the year. And within the super, within your personal superannuation, the super would take out 15% tax on this $110,000 that you contribute as a transactional contribution, which it ends up to be 16,500. So if you look at this formula, you could achieve a tax saving of 15%. Instead of paying 30% tax, you could be paying 15%, which is inside your super. It can help you, one, reduce your tax, and sometimes also help you catch up on your super because if you're an expat being living overseas for multiple years, generally speaking, your super balance in Australia will be behind the people in Australia because you have not been making any contributions. So it could be useful that one, you can help to catch up on your super, and secondly is to reduce the tax payable if you have some huge income that you're expecting to come for the year. So we can play out this super strategy to help you minimize the tax payable. So this is what an investment property, what we'll be looking at when it comes to the calculation and what are the methods that we can help you to play in and try to reduce some of the tax payable. All right, let's have another scenarios. Let's say still this is an investment property, the same situation, 70K. That's how much you bought for. You're selling for 1 mil with a cost of 90K, tax loss of 100K, etc. But you are a part year resident and a part year non-resident. So assuming you bought a property in 2016 and lived overseas until 2020 and moved back to Australia and sell the property in 2024. So how does it work in terms of the calculations when there is a part year resident and part year non-resident involved in this? So what we'll be looking at is the same calculation. You're going to have a capital gains of 210. However, what we'll be looking is like a pro rata calculation to see out of the 4 year that when you're back in Australia, when you are having entitlement to that 50% capital gains discount, what sort of capital gains can you apply and reduce the tax payable? So you're going to own the property for 8 years. The eligible CGT discount is from 2020 to 2024, which is 4 years. So the discount will be 210, which is your capital gains times 8 out of 4, half of the time when you're back in Australia, and at 50% discount. So your CGT discount will be at 52,500. So the net capital gains will be 210 less this discount. So you're gonna have an income of $157,000. And then minus the losses that you have, the 100K that you have. So this will further bring down the taxable income to only at 57,500. And because you're a resident of Australia, you get the 18,000 threshold. Your rate starts from 16%, much lower than a non-resident. So you would end up paying only $8,000 in this example. Assuming you have no other income, this is your pure income that you need to report for the year. And again, we can still apply the super method to even bring down the $8,000 to potentially half of it if required. So this is the scenario when it comes to if you hold the property sometime living overseas as a non-resident and come back to Australia eventually, or you own as a non-resident and then you own it as a resident when you were back in Australia and move overseas and sell when you were living overseas. So this is the pro rata calculation that we'll be looking at. I've heard people say, "Oh, can I use a market value approach to look at the day when my residency switch?" Unfortunately, no. ATO does not accept that evaluation as a method. They will only accept, in this scenario, they only accept a pro rata apportioning method to do the calculations. Okay, and let's talk about another scenario. Let's say you own the property before 2012, before the residency before the capital gains discount rule change. How does it impact you? So the example here is this is Australian expat who bought a property in New South Wales for $100,000 in 2000, which is before the 2012 rule change, and sold the property for 1 mil in 2024 with associated cost of $90,000. Same thing, including stamp duty, all the costs of buying and selling, and with the tax loss of $100,000. So because the rule changed in May 2012, so this expat should be eligible for the 50% capital gains tax discount from 2000 to 2012, and then no discount from 2012 to 2024 when he sold the property. So what we're gonna look at is one is apportioning method, but that probably would not give you much of benefit. So what we'll be looking at is a market value approach, which we need to get a market value on 8th of May 2012. The higher, the better, which means most of your profit is made before May 2012 when the rule has changed. So assuming the market value on this day is at $800,000, which means um, from the example here, the eligible capital gains tax discount from 2000 to 2012 would be the 800K, which is the market value in 2012, minus the cost you bought it, 500K, which is the 300,000 profit. So you make $300,000 within this 12 years period where you're eligible for the capital gains discount. So when we apply the discount, it will bring your discount down to $150,000. So your net capital gains is 410 minus 150 that you're eligible for that 12 years. So you will only need to pay tax on this 260. So instead of paying tax for 410, your capital gains, you will only need to pay tax on 260. Okay, so this would help you to minimize tax payable. Again, the losses will also come to play. It will further bring your income down to 160. And because you're selling as a non-resident, this is how much tax you need to pay, which is just below $50,000. You can do the same if we can apply the super strategy. We can try to bring this down to half. So you may be looking at just underneath $25,000. It would play with the super as well. So this is the method that we're going to apply when you hold an investment property before May 2012. How does the calculation works? That we need to get a market valuation report on May 2012 to figure out what sort of profit that you make up until this date that you can still enjoy the 50% discount. Okay, so another example, this is the one that I mentioned, the main residence exemptions. So generally speaking, if this is your main residence in Australia, that should be exempt from capital gains tax because everyone can have one property to be their main residence, to be their PPOR, and they pay no tax on that property. However, with this rule change in 2020, ATO is removing this exemption to be selling as a non-resident unless the very specific, we call a live event would happen, which those are difficult to be applied. We have seen cases that can be applied, but this is something more likely to relate to like a divorce, breakdown of marriage. Then we call this live event will kick in, which unlikely that would apply to you. So if let's say you can't get it, then how does it impact you if you sell a property as a non-resident and then you lose the main residence exemptions? So similar example here, you bought a property in New South Wales for $100,000 in 2013 and living as your primary residence. And you left Australia in 2020, move overseas to be a non-resident for tax purpose, and you sell the property in 2024 for $1 million. Associate cost of $90,000 because you have been living in the property and the property has been positively cleared because you have no mortgage on it. So there has been no accumulated tax losses on this property. So we're gonna take away the losses consideration in this example. So if that is the case, then Again, we're gonna figure out what is your capital gains on this calculation first, which is $410,000. You own the property for 11 years. However, even though they removed the main resident exemption from you on this property, but given you have been living in Australia for some years, you can still treat it like an investment property and can at least get the 50% capital gains discount to further reduce the tax. So that which is 7 years. So 7 out of 11 is where you can get or enjoy the 50% capital gains discount. So that formula comes down to $130,000 is what you can take away from the capital gain. So at the end of the day, you will only have a net capital gains of $279,000 and you pay tax on this one at a 45% bracket, but this is the effective number. So 101,000 goes to the tax office. Yeah, we can still look at the superannuation strategy to try to reduce the tax, but it still costs you something when you try to sell something which sell your main resident, which is supposed to be exempt from capital gains tax. So this is the trap. If you fall under, you will be seeing an issue when you try to sell your main residence while living overseas. And instead of selling the main residence, what you should be looking to do is in this scenario. You should try to hold the property and try to sell as a resident when you move back to Australia. Say for 6 months, make yourself the criteria, the condition that we are looking at here. The scenario is the same, but the condition that we are looking at here is you come back and sell the property as a tax residence. This is what everything changed. And to secure this status, I would say, yeah, go back, at least stay for 6 months to make sure you can be seen as a tax resident before you sell the property to make sure you can claim the main residence exemptions on this. So if you can apply the main residence exemption on this one, under this scenario, because you've been living in the property from 2013 to 2020 as your main residence, you pay no capital gains tax for that 7 years. And we have another rule, which is a 6 years rule. When you first rent out your main residence, you can still enjoy up to 6 years of exemption of paying no capital gains tax. So in this scenario, the property is only rented out in 2020. We can apply the 6 years rule, which will cover you until 2026. And in this example, the client go back in 2024, so in here, 2024, and move back to become a tax resident. So this is still being covered by the 6 years rule. So with this perfect timing, the whole ownership of the property will fall under the exemption that you pay no capital gains tax at all on this example. So instead of paying 110, 100,001 to the tax office, you would be paying zero compared to when you're selling as a tax non-resident of Australia. So this caused a huge tax bill if you time your situation perfectly, or at least try to understand what are the difference. Unless you're in under urgency that you really need to sell the property. Otherwise, my suggestion would be try to hold on the property, which was your main residence, and try to only sell it when you come back to Australia. That you can minimize your tax by quite a lot based on the calculations. And this one, the foreign resident capital gains withholding. So those are the example we talk about how the capital gains calculation works. And this is something different. So this foreign resident capital gains withholding, this is not additional tax, so don't worry about, oh, do I need to pay more now on top of the capital gains tax? No, this is just tax in advance. The whole purpose of government, the ATO, try to bring up this is just based on the history in the past that for people living outside of Australia, there have been cases that they don't pay their tax in Australia. They sell the property and just goes to the government. And you can imagine it's very hard for the government to try to track down someone living overseas. So the pure purpose for this is to avoid tax evasion for people living overseas. And the government want to take an upfront tax in advance when you sell your property. They want to take some sort of money to be seen as your potential capital gains tax and they want to keep it until you update them on your stories, on your situations. This is what has always been the case. At the very beginning, we started with property over 2 million. Then you need to pay some money to the tax office. It further reduced to $750,000. And just in this year, beginning of this year, 2025, that threshold changed again. So last year, we're looking at if you sell any property for more than 750, you would need to put a 12.5% withholding to the tax office to be seen as your potential capital gains tax. This year, the rate change, it has increased to 15%, and it applies to all of the sales price, any price point, even though you're selling for $1 to your friends, your family. ATO will still want you to take a 50% withholding on the sales price. And this money goes to the tax office at the settlement. So you don't get it at the settlement dates. And how does it affect you? So if you're a tax resident in Australia, that probably wouldn't cost you too much of hassle. Just some paperwork that you need to do that you can apply for a clearance certificate, which ATO knows that, all right, we know you are a resident of Australia, we know you're living in Australia, so it's actually easier if we need to change your tax, that we can always find you, given you're in Australia, than someone else who are living overseas. So that one you can apply for clearance certificates, which is simple, a form to be filled out with a tax office, and they will check your tax record. If you're up to date, you're not owing anything, they would issue the clearance certificates. And you can give this to your solicitor. They will know, all right, you are not required to withhold a 15% tax at the settlement. You can take 100% of the proceed in your pocket at the settlement dates. But when it comes to a non-resident, then we don't get it. So we would need to apply. We don't get a clearance certificate. We need to apply for a foreign resident capital gains withholding variation. So we can only change the rate of 15% to something lower. Um, and in order to do that is we need to show the ATO the calculation on capital gains tax to show them, all right, this is the math. I actually don't need to pay 50% of my sales price. I can bring it down to 5%, for example. Then I agree to only withhold 5% at the settlement and send that to the tax office. I should get back 95% of my money at settlement dates on these conditions, which is you are up to date on your tax return, you have no outstanding tax returns, and you are not owing any tax bill to the tax office. And you need to provide supporting document to show to the tax office how the calculation is done, how much did you buy for, and how much are you selling, what is the cost involved in only holding the property, to show them the full capital gains calculations, or if any of the tax losses that you have, they would check from your past record tax return to see whether these are the exact losses that you have accumulated up to date. Some people are in a hurry because they only realize this when really getting close to the settlement dates, that they have been trying to get their solicitor to do the clearance certificates, which eventually get rejected because they are non-residents, and the clearance certificate does not apply on non-residents. So if that happens, you would just need to let the ATO take that 50% tax at the settlement. The thing you can do is you can submit a return at the end of the financial year and to show the tax office that this is a calculation, whether you can get a refund because your tax payable is lower than 15%, or you need to make or your tax liability is actually higher than 15% and you need to make the difference to the tax office. This will cause a delay. Imagine if you're selling a property in July 2025, and you just couldn't get the variation done in time. You need to let ATO take that 50% until July 2026 next year. You need to wait for a full year until you can submit a tax return and get a refund back. So that could sometimes affect the schedule or planning that you have because you probably need that money for something else. That's 15%, it's not like 5. So it could sometimes cost you something. So if you're looking to sell, I would suggest you to look into this, make sure you run the calculation to see whether you can get the money back earlier or you just need to let ATO take some money at the settlement. So yeah, these are the common mistakes that we've been seeing from our clients, and maybe some of the strategy that you can look into to how to reduce the tax, especially on capital gains tax. One mistake is yeah, misjudge the tax residency. That you thought, oh no, I can still enjoy the 50% capital gains discount, or I can still enjoy the main residence exemption. And I just sold my property. I wasn't sure, but I just go ahead and sell the property, and that costs you a lot. So these are the example that, like with proper planning, you can definitely avoid. And more other common one is like you just miss out some of the deductions that you can claim to minimize the tax. And if you can, if you're in Australia, try to hold the property for more than 12 months so you can enjoy that capital gains discount, the 50% discount, to minimize the tax. It's important that you keep your records, that you could have bought a property 20 years ago. Did you keep the document 20 years ago so you know what costs that you pay for? And this is important if you're working with accountants, they usually help you to keep the document. So when it comes time of selling, they would know, all right, you bought it for this much, and these are the expenses to help you further minimize the tax payable as well. Um, so, and a few more tips to try to save a bit more. So if you having like one of the example here is if you have loss-making assets like shares, you make loss on the shares. Maybe you just want to consider selling the assets and just capitalize the loss, and which can be used to offset the capital gains on property, which can reduce your capital gains payable, and you can reinvest the money for better investment. Just admit that you made a bad decision, take the L, and let's move on. It probably wouldn't worth time to keep holding the property, which you don't know when it will come back, and or something that may not have a future. Maybe it's better to move on and to reconsider investing that money on something better and wiser. Also, you can consider the ownership structure, which is instead of buying jointly yourself, maybe it could be something owned with your partner and a joint ownership. At least we can split the capital gains 50-50, which potentially can bring down the you to a lower tax bracket, and also the super. Instead of having one super that you can claim, now you have two people, you can claim two superannuation to minimize the tax as well. Or you got a partner who is living in Australia or moving back to Australia, it might be worth to consider buying under their name so at least they can at least get a 50% discount if this is an investment property or this is something they're gonna move and live into, so they can claim as their main residence, rather than you being a non-resident for tax purpose to hold the property and get yourself exposed to the capital gains and higher tax payable. Okay. And one thing here is if we are capable of handling the share market, the equity market, it could also be wise for you to look into buying and selling Australian shares as a non-resident because there's no capital gains tax. You don't literally pay any dollar on capital gains to the tax office as a non-resident. Again, this probably will require um, some skills on the equity market and depends on the market itself, I guess. Other things would be one of the very common questions that I've been asked, which is what happened to my overseas assets when I moved back to Australia? Say I have a property overseas and now I'm going back to Australia. I want to keep the property because I don't know whether I'll be coming back, and that may be a scenario that will be come back after a few years when am in Australia, and this is a property that I'm gonna live into in the future. So if that happens, then you probably don't need to worry too much about the capital gains because it's going to be a fair game by the tax office as well. If this is something you bought as a non-resident of overseas, whatever profit that you make for the time being when you're living overseas as a non-resident would not be taxable in Australia. So we will only look at using again the market value and the dates when you come back to Australia to see what sort of profit have you make afterwards. So there shouldn't be a hard requirement for you to sell any of the overseas assets when you are thinking of coming back to Australia and becoming a resident. Again, we're going to be using the market value to see what sort of profit you make in the future. At the end, when you sell, that's when the capital gains will kick in. So to take away, it's very important to understand what is your tax residency because it definitely affect on the capital gains tax, whether the discount or the main residence exemption will apply to you. And plan your time, plan the sales around the timing, whether it's you're gonna sell as a non-resident or sell as a resident, how long you hold the property, would you be required to pay the 50% withholding tax, and keep all the details on expenses. That those are the ones that we can claim to help you reduce the tax payable, and try to take advantage of the negative gearing. If you having accumulating some losses over time, these are the losses that can help you to reduce the future income, like the capital gains when you sell the property. And utilize the super if you can, which also help you to save tax. So hopefully that give you a section on the capital gains and through those couple scenarios that also help you understand how the calculation is being done. And maybe we're gonna do some Q&A for now. So I'll pass back to Tatata. Maybe Tatata, you can run some questions that we have, and let's go over some of them.
Amazing. Yep. Thank you so much, Pao, for all those insights. And it's raining questions right now. So I'll just quickly go through the questions that have been popped up, starting off with how do you pay CGT as a non-tax resident with no tax files?
Yeah. So again, this will come in that you need to have a tax file number. That the first thing will kick into you is that 50% withholding. So without the tax file number, then that becomes a problem that ATO don't know where you can send that 50% to, who that money belongs to. So you need to get a tax file number in Australia when you are thinking of selling property, because without the tax file number, we cannot do the variation for you to bring potential. Let's say you don't need to pay any tax on the property. We can't, without a TFN, we can't help you to bring it down to zero and you get all the money back. And so as we cannot, if you need to pay tax, ATO don't know who that money belongs to. So I would suggest you, if you're thinking of selling, that you should get the tax file number sorted out first. It would take about a month for people living overseas to apply for a TFN in Australia. There's some process involved. It probably takes you about a month to get it.
Perfect. So next question on a random basis is how is depreciation accounted for in terms of CGT?
Yeah. So if you have been claiming depreciation on renting out on your tax return when you are renting out your property, yes, we need to also factor in the depreciation that you've been claiming in the tax return. So in the example, I'm not factoring that in because I don't want to make it too complex and too confusion. But yes, depreciation is something we need to factor in. And why people are still doing that, if we eventually need to capture the depreciations in the tax return is it helps you to reduce your tax every year. So it's helping you to delay the tax payment to say instead of paying every year to the tax office, you are delaying the capital gains to say 10 years after. So that's something to do with the dollar value. A dollar right now is definitely worth more than a dollar in 10 years or 20 years. So that's why you would like to delay the tax payment as late as possible.
Okay. So the next question is are expenses such as council fees, strata, water fee allowable deductions?
So those are generally deductible. Let's say if you have been renting out the property, then those are the expenses that you'll be claiming when you submit your tax return, report your rental income, etc. But if this is something like say holiday home, you never rent out the property, but you have been paying the council, water, interest, etc. So these are the costs that we call as an ownership cost. So if this is the case, then yes, we can claim these expenses as a cost, as a cost base into the capital gains calculation to further reduce the tax payable.
Great. Uh, okay. So Belinda asks, what is the basis for calculation of accumulated tax loss? How is this different to the tax offset received for an income tax year if an investment property is negatively geared?
Yeah. So the losses, the tax, the accumulated tax losses, one, it's going to be indefinite when you carry forward them, so it won't expire, and that simply reduce your future income. So it's hard to put a tax rate bracket on these numbers because it really depends on what income are you getting. It simply offset the income for the future first, and then we look at, all right, what sort of how much do you have left, and you can apply, or you have been applying all of them in a year. It can help you to bring your tax bracket from 45% to zero. In that regard, then you can simply say I'm saving 45% on these losses.
Okay. Okay, I'm just going all the way down. Is there any strategy to avoid paying the foreign land tax surcharge 5%?
Yeah, and that is a tough one. That hit a lot of clients, and that happens to my client, especially they're foreigner or they're PR living overseas that have been hit with this surcharge in New South Wales in particular. It's hard to get away unless one of the strategy I've been doing for my client is we just need to look at doing the transfer to an Australian partner, for example. The case we have is a non-Australian citizen owned with a PR but living overseas, and the PR portion is being triggered on the 5%. So we do a transfer to bring the property back to the Australian partner's name so we can avoid the 5% surcharge. But that will come into you need to pay the stamp duty, you need to calculate the capital gains altogether. It can be a math to determine whether it's um, worth to do so. It depends on how long you plan to hold the property for.
Okay. Um, okay. One anonymous attendee asks, I moved from overseas to Australia 2 years ago and forgot to value the overseas property at that time. What should be done?
Um, that one depends on whether you can do a valuation and if that helps you. And if it does, then you don't need to worry about I haven't done in time because the valuer in Australia, they can also do a retro valuation. So we can always go back and say, oh, what is the market in 2 years ago and what you could have been sold for that property 2 years ago. So you can always go back to the valuer in Australia and get them to do a report retrospectively.
Okay. There was one regarding this itself that I was searching for, but if I find it, I'll probably ask you on it. But Gerson asks, can you deduct all costs? Oh, you just answered that question as well. By using superannuation strategy, oh, it just moved up. Just a sec. We're getting a lot of questions and the questions are moving up.
Maybe I had see one here from
Mhm.
Nathan. Can you make the contribution after the sale of the property and use the proceed? So when we come to this super, the timeline that we are looking at is every 30th of June every year. You need to make the contribution before 30th of June every year. So yes, it can be done. You can still make the contribution after the sales of a property, as long as both of them happen in the same financial year, which means you can sell the property in December and only make the contribution in June. You can still keep the funds to your pocket until the last minute, and you can do the contribution in June.
Okay, we have a lot on superannuation strategy. So can the superannuation strategy only be used when you're a resident of Australia, but you were previously a non-resident?
It doesn't matter. The super strategy can apply on either resident or non-resident. But when you're a resident Australia, part of this 30,000 cap is coming from your employment. If you have been getting super guarantee, that's some part of the money from the employment actually contribute to this. So which means you probably would not have much left to make the contribution. But if you're non-resident, you're not making any income from employment income from Australia, then obviously the 30,000 is something they can fully utilize.
Okay, one more on superannuation. So can you, oh, okay, can the superannuation strategy apply to each person who owns the property? So the potential to deposit to superannuation per person.
Yes. So let's say there are two owners of the property, then yeah, we can play because at the end of the day, the capital gains will be split 50-50. And then we just look at that individual A, can you apply the super to minimize your 50% capital gains on the property? Can individual B do the same to further minimize? And this is one of the strategy that I mentioned, tips that holding joint name could sometimes help you to bring down the eventually tax payable on this one.
Okay. So related to the 6-year rule, what happens if you rent it out for a for longer than 6 years?
Yeah. So in that scenario, what we be looking at is we will only look at the year that is beyond the six. So let's say you rent out the property for 7 years, we will only look at that 1 year to be taxable. So you could be owning the property for 20 years. It is only 1 year that is liable for capital gains. We would do a pro rata calculation by looking at 1 out of 20 and how much tax that represent for that 1 year, and you only pay tax on that 1 year. Again, the condition is you have to sell the property as a tax resident of Australia. That's the basis when you can get the exemption, the main residence exemption, and a 6 years rule exemption to be applied.
Okay. Vicky asks, can you apply for certificate? It's going up again. Okay, I'll just have to move on to another question because the questions are moving in. What sources does the tax office accept to value a property retrospectively? Sorry.
Yeah.
Example, core logic data for average house in the same postcodes. How accurate does it need to be?
It has to be very accurate. So ATO will only accept a valuation report from a certified valuer. You can't use the CoreLogic report or a system generated report or a market appraisal from a property agent because they are not qualified to keep anything that can be used for tax purpose.
Okay. If I sell as a foreign resident US, do I pay US CGT?
Yes, potentially. If you having a capital gains in Australia, you will also, it depends on your residencies. You might also need to pay tax in the US. But because we have a DTA, double tax agreement between Australia and US, whatever tax you pay in Australia will be used as a credit to be recognized in the US. So they will only look at the difference. Do you need to pay 5% more in the US or you already pay enough in Australia so that they won't tax you anything further?
Okay, there's one specific sort of a question that I found. It says, say I purchased rental in 2007, left Australia in 2014, sold in 2025. Would the CGT be evenly distributed over 18 years? Then the 50% CGT discount be applied to the first seven of those 18 years?
Yeah, if you are qualified for the 50% discount, then yes, it's going to be a pro rata calculation. Like the example that we did, we need to figure out what is your capital gains and then apply the proportion on how many years you can get a discount and how many years that you don't to work out what is the capital gains discount that you can get.
Okay. So that would be the last question that we'll be taking in, but there is an exciting announcement that I have, for which I'll just share my slides here. So live question answers are always great, right, Pao? We always have questions raining in whenever we do a webinar. So we just felt like there are a lot of great questions that are left unanswered, and we wouldn't want that happening all the time. So, we're giving out a special offer for all the attendees today so that you can get the answers for all the questions that you have. And that is a free one-on-one consultation with Pau, which normally costs 300 AED. And this is so that you get like personal guidance from Pau himself, a 30-minute straight dedicated time. So please book your consultation with Pau with the link that is shared on the chat, or you can also scan this QR code on the slides. This offer is only valid until 31st of March, which is like a 1 week period. So book your consultations right now so that you can get your personalized guidance at no cost. So I'll just give everyone a bit of time to screenshot the slides and also to click the links that are shared on our chat. That's pretty much it for today. Thank you so much, everyone, for joining in. Thank you so much for amazing questions. And I hope this session was as insightful as it was in our previous webinars as well to all the attendees. Thank you so much, Pao, for giving us all these values. And yeah, see you guys in the next webinar.
Right. Thank you, guys. Feel free to lock in a time with me if you want to talk about your personal tax, and I look forward to help each one of you.
Thank you so much, everyone. Have a good day. Have a good night, wherever you are. Thank you.
See ya.